Let me bring on Ryan Irvine. You know him well, of course, with Keystone Financial. You can find him at www.keystocks.com. Ryan, thanks for finding time for us this weekend.
It's great to chat with you once again. I wanted to thank you for putting on a great Outlook conference earlier this month. It's such a great event, and thank you for putting that together.
Well, I appreciate that very much. One of the things that, both of the Outlook that you can see every day in the newspapers, I just chatted with Rob Levy about it. Boy, it is Trump's world right now. If you take it in terms of the amount of coverage he's getting, the pronouncements and the tweets and all of that stuff. But as an investor, I mean, we're trying to make sense of that. So let me just give you that broad brush question. Your specialty, and not Keystone's. Keystone also, I think, does a fabulous job when they look at conservative stocks and conservative/growth stocks. You look at the small cap stocks, and that's how you guys started, and you've had a great track record with that. But what about picking small caps in a Trump world?
Oh, I think it's a great question. It is interesting times when we see late-night tweets from a president having more influence near-term on the markets than the U.S. Federal Reserve. This really wasn't the case under the previous administration, but there's a new sheriff in town, and everybody is trying to position themselves to best take advantage of some of the policy changes under the Trump administrations. And we think there's a couple areas that we want to really keep our eyes on. Of course, there's the promised tax cuts, but we're also looking at the infrastructure spending. But we advise to really take a strategic approach here. So our strategy is to look for stocks that we would buy with or without Trump in power, but could gain some blue sky potential if one of the Donald's policies move forward. So we actually made a recommendation in this regard earlier in the year, and it's worked out quite well so far, and we think it still has significant room to move. But the Donald himself has made some bold and even outlandish promises leading up to the election. I think at one point he may have even claimed to have invented the question mark, but we do think there's a better than average chance that he moves forward with his planned infrastructure spending. But however, I don't think there's much of an appetite out there to increase taxes to pay for the much needed roads and bridges that we see in the U.S. So his promised private and public partnership model would see Americans pay for infrastructure during their daily commute via, say, tolls, rather than at tax time. And this could be a viable option. Now, under that model, the roadway infrastructure must have a revenue stream attached to it. So to provide an economic return for the private developers and the public-private partnerships. This is fundamental to Trump's plan, and the most fundamental enabler of this type of technology comes through what is called intelligent transportation systems. And this is the design and the hardware and the software behind the manufacturing, the integration, and product systems to really improve traffic flows. And that includes devices such as automated truck-way systems and toll road systems and equipment and all the data monitoring that comes along with that. And, through our research, we look at 3,000 companies in Canada every year and 2,000 into the U.S. We happen to come up with a company that has, it's the leading market share company in this market, in the ITS market, the Intelligent Transportation System market, with 20% market share. It's a little company that was based in Saskatchewan. So we recommended it earlier this year. It's had a 50% rise since then. But I think when we found it, it was probably 60% undervalued. And, if it continues to grow at the rate it's growing, then it offers good value going forward. So those are ways that we can participate in a stock that is levered towards what Trump may do with his policies. But always knowing that we would have bought this stock regardless of whether it's Trump in power, whether it's Clinton in power, Obama in power. But now we can get that boost up from some of his policy decisions going forward.
But a couple of things are really interesting there. I mean, one of the things about that infrastructure plan is, keep in mind, the Democrats would also be in favor of it. So it's not the same, like other things, they will not be in favor of his tax plan or certain aspects of the tax plan. Obviously, other things are clearly contentious. But the infrastructure, that's why you haven't heard a ton about it, because it's not contentious. I mean, the American infrastructure is in real problems. I mean, I've read numbers like there's 260 or 2,600 bridges, rather, that kind of stuff. So that one looks like, I think you're right, that's going to be a go, and it's also going to be key in terms of economic growth. We've seen cement companies, for example, pick up, that kind of thing. But I'm fascinated by what you're saying here. It's an aspect of that they're going to have to get a return. I think that's a great point you're making. So there's going to be a whole bunch of technology involved in measuring, collecting money, that kind of stuff. I just think that's a fascinating area that you're looking at there.
Yeah, and if you want, we can actually talk about a company that we're recommending in that segment right now. We can talk about it's called International Road Dynamics. Its symbol is IRD on the TSX. The stock we recommended just to start this year, it was about the $2.30 range, $2.40. It's today trading at $3.70. Like we said, it was probably 50% undervalued then, so it's still got some room to move. They are a highway traffic management technology company specializing in everything from those automated weigh systems, so you don't have to have a truck go in and drive into and get weighed on the side of the road. It's done at highway speed with a company like this. They specialize in toll road systems. So the 401 highway in Toronto, they were largely involved with that, which has been a very, very successful public-private partnership. It's really an unknown little company. They'll do about $75 million in revenue this year. That's up 25% from last year. Likely earn 19 to 20 cents. That's up from 15 cents last year. So you're looking at 30% revenue growth. We expect going forward, the market's always looking forward, is there going to be growth next year? We expect them to grow 25 to 30% in terms of earnings next year. Right now, that gives it a forward PE of about 15. The market's trading at a forward PE of at least 18. Some would say it's in the range of 20. But, this stock gives you good value, but also upside to the Trump infrastructure plans being aggressively implemented. If they are aggressively implemented, this company is positioned to profit for the next 3 to 4 years. And you're buying it right now at a relatively reasonable price, and it's basically uncovered in the market. So this is why you've been able to be seeing a good, strong gain to the start of this year. And we think, 3 to 5 years out, it's a good buy here.
Well, it's interesting. At the World Outlook Conference, that formed one of the core positions in the World Outlook small cap portfolio. That was about 260. That's just going back to February 3rd and 4th. You spoke on the 4th. 260, now 370. You got a good head start on next year's portfolio. And isn't that terrible? Because every year, Keystone Financial has done so well with us at the World Outlook Conference, putting a portfolio together, people who want a growth, small cap growth stocks, and last year was over 30%. You got a big start, and it's just the "what have you done for me lately" kind of attitude. Yeah. Can't you ever take a break? Well, you didn't with this one, but that's a fascinating story, Ryan. An absolutely fascinating story.
We love the story behind it, and we love the growth there, and the fact that you can buy a company that we buy with or without Trump in power. We think that those infrastructure spending goes through regardless. It may be sped up under his administration, which would be nice, so it gives you a kicker to growth going forward. And it's just a really unknown story operating out of Saskatchewan that's been around for a few decades now that is a real success story and could have some sex appeal to the story going forward with the Trump administration. So it could get an uptick in terms of the multiples it's applied to the stock.
As I said, you talked about it, the World Outlook at 260 is 370. That begs the question, what about selling? When do you decide to sell? I'll ask Ryan Irvine about that when we come back. Winners are great, but you want to be able to take the money off the table at some point. I want to know how he does that, and we'll do it right here on the Money Talks Network. Stay with us. I think the world would be a better place if we all woke up to James Brown every morning. Certainly gets your energy going. Ryan Irvine on the line with me right now, Keystone Financial, but find him at www.keystocks.com. Ryan, just before the break, we were talking about, recommendations like International Road Dynamics. But what about the sell side? Because I look at that and I go, my gosh, you're up around whatever that is, 40% in a month. I can't even do the annualized rate of return on that. And someone might be tempted to go, well, why don't I sell it right now? Why don't I clip that kind of $1.10 profit on a 260 investment?
Yeah, I think that's it's such a good question because, everybody knows how to buy a stock, but sometimes the toughest decision is when to sell that stock. It's hard to find the right stocks to buy, but it's definitely, hard to make that sell decision. We, as we're fundamental analysts, we look at a company, what we'd say, exceeding its fair value, and that fair value would be based on earnings and cash flow and what we expect going forward in terms of earnings and cash flow. And it exceeds that by, say, 20 to 25%, we start to look at selling the stock. Now, we also have to take into account the general risk level of the stock, so we break it down into two types of areas, broadly speaking. You'd look at long-term cyclical stocks and non-cyclical stocks. So a cyclical stock would be a stock that's business is dependent upon the economic cycle or an underlying commodity, and then a non-cyclical would be a recession-resistant business that is not dependent upon a business cycle or a commodity price. A great example of that type of stock that we've recommended is Boyd, the Boyd Group. All they do is fix cars and glass repair. People tend to fix their car because it's their means of getting from A to B, recession or not. So that's a good example of a non-cyclical. When we look at cyclical stocks, we tend to not hold them too much past their fair value, maybe even 10% to 20%, and we'd take some off the table because of those companies. They always face a cyclical downturn at some point. And I love to give examples, and if we can do that today, I'd love to give an example because we've talked about this company, High Arctic Energy Services, it's HWO on the TSX. We've talked about it a number of times on the show, and we've recommended it, the Outlook. It's a stock we actually recently sold, and it's at times it can be a painful decision because we like the business, we like the company, and it was not terribly expensive when we chose to sell it. But we bought it 4 years ago at $2.20. It's raised its dividend 3 times. We sold just recently at $6.20, so it was up 200% for us. We don't want to get too greedy, but we saw a fair value of around $5.20, $5.25 in that range. So it was exceeding the fair value by about 20%. And we thought, it's a great time to take some profit because this lumps into that cyclical category. They are dependent upon on an underlying commodity. They're an energy service stock, so they're dependent upon oil and gas. And some of the people that we follow in that segment are predicting some short-term weakness potentially in the price of oil. The stock is up 65% in the past 5 months. That's when we take some profit out of the company. It's strange because it's a good company. And it would be our go-to name in this sector, but is it a reasonable price right now? We say no, and we'll take that profit off the table, and we've never lost money doing that.
Yeah, look, one of the things that occurs to me, would you keep it on your radar screen, though, in case there is a correction in the market? And again, you'd have to determine, is that correction justified by company performance or the cyclicals, oil prices drop back down dramatically and you think they're staying there, all of those things. But you'd at least keep it on your radar with at least a thought that at some point that value may develop again for you.
Yeah, without a doubt, that's the situation, and we said that in this report. We like the business, we like the company, we like some of the moves that management has made, and we are monitoring this company for a potential re-entry point if we see the price of oil coming higher, and given at that time management is still managing it the same way we see it now, and there's still good cash there. Yes, it is a company that we would be a go-to name for us if we thought energy prices were on the rise long term.
Again, I love that distinction you're making, though, between stocks that are cyclical and stocks that are not. They're just part of the, kind of business environment. And, Boyd Auto Body's been an unbelievable success that you've recommended here on this show and at the World Outlook going back several years. But again, a non-cyclical business. People are always going to repair their cars. They're always going to have windshield problems, that kind of stuff. So
it's one that we'd love to continue to own on into the future because of the fact that it is non-cyclical. And there would be a point that it could get so far above fair value that we may take some profit out of it. But as long as it continues to grow at a tremendous rate and continue to, it's in that non-cyclical space, we like to hold on to a winner.
Let me come to something else you recommended at last year's World Outlook Conference, and I like the theme of what you done earlier when you talk about there's this broad infrastructure thing we should pay attention to, and then we look for companies. Well, here's one that we've all heard about now, at least, maybe a few years ago we hadn't, but it's the Internet of Things. That huge trend that's going on. Well, when we go back a couple of years, You recommended that stock at the World Outlook at 60 cents. It's over doubled right now. I saw it at 135, I think, this week. Just give us a little example. Where are we at with the Internet? We only got a few minutes, but Internet of Things, and specifically with photon control.
Yeah, Photon Control is a company that we do continue to recommend today, PHO on the TSX Venture. Its growth is powered by this growth in the Internet of Things, or this world where machines are embedded with sensors that allow them to relay data to each other with little or no human involvement. It basically means all sorts of devices are connected to the Internet and talking right behind our backs. Now, the Internet of Things, it's been around for a while, since 2008. Or in 2008, there were already more devices connected to the Internet than there are human beings on the planet. Now, 3 years from now, Cisco says there's expected to be 50 billion devices connected to the Internet. Almost all of these devices need semiconductors, and Photon Control specializes in helping semiconductor manufacturers essentially manufacture semiconductors. So they're the backbone of that industry. They're optical sensors and instruments to measure temperature and pressure, assist in the manufacturing process of semiconductors. So it's not hard to see why this company is now reporting record backlogs, and its stock is up 125% over the last 12 months. But, all we see here is compound annual growth rate in terms of revenues for the past 6 years of 25%. They've gone from 2012 at $10 million in revenues. This year they'll do $30 million. In 2012, they had $3.6 million in cash in the bank. At the end of this year, we think they'll have about $33 million in the bank, and they have no debt. So they're trading at $1.30, but about almost 35 cents per share is in cash. So you're really only paying $1 for the business for a company that could earn 8 to 9 cents this year. Just over 11 times earnings. Its growth right now, it's a reasonable price. We know their next quarter is going to be a record because they have a record backlog going into that. We'll monitor that situation going forward, but as long as they continue to produce record results year over year and trade well below what the market multiple PE is, we'll continue to be a buyer of the stock.
Yeah, and it's such a fascinating area also to focus on with the Internet of Things, and I know that's a broad statement, but, the growth, as you just alluded to, in terms of the number of devices hooked up, for example. Ryan, I want to thank you for taking the time, and I want to remind people to go to www.keystocks.com. That's where you find Ryan Irvine. You can find Aaron Dunn there talking about more conservative vehicles, Ryan looking at the small cap. Ryan, thanks for taking the time.
Thank you very much. Good to talk to you.